Welcome back to the pricing channel for small businesses. This will be our last video for the year 2021, and so I think it is especially appropriate to finish the year on a pricing topic that can add a lot of firepower to your search for new business opportunities. You see, we're going to be talking about the pricing strategy known as variable cost-based pricing. Sometimes this strategy is called cash-based pricing, other times it's called incremental pricing. But whatever the name, it refers to pricing based on the variable cost involved in going after a new increment of business. Looking at a profit and loss statement like the one we show here, it is those expenses that appear in the cost of goods sold section of that profit and loss statement that are used for establishing our pricing. Now, why do we do that? And how does it work? And what are the benefits of this kind of pricing? Well, let's take a look at this presentation to answer all those questions.
Variable cost-based pricing is a pricing strategy which is based on those costs which vary with sales volume. Now, it's sometimes called cash-based pricing because in effect we're looking at cash costs that we incur to go after a new increment of business, and so we base the pricing on those cash costs. And it's also called incremental pricing just from the standpoint that we're going after a new increment of business, and so we develop a pricing specifically for that business increment. Variable cost-based pricing typically only considers direct costs for price determination purposes, and these are the costs that appear in the cost of goods sold portion of our profit and loss statement. And we use gross margin for setting price also. The reason why we only look at costs that vary with sales volume, or those costs that appear in the cost of goods sold portion of our profit and loss statement, is that we assume we're going after an increment of business that will not increase our overhead expenses. In other words, we believe that we have some extra capacity in our business to take on more business without adding any staff, building space, or increasing insurance or any other overhead expenses. And since we don't have to increase any overhead expenses to take on this increment of business, this means that we don't have to consider overhead expenses in our pricing determinations. So to illustrate how this works, let's take a look at an example of how this could take place in a service business. And so here we have a profit and loss statement for a family medical practice. It's a profit and loss statement from a particular month of the business. We have revenues, and we have our cost of goods sold, which in this case are supplies that are expended to see a patient, as well as the salary for a physician's assistant. And then we also have all of our overhead expenses for the business. Now, one way to approach an incremental pricing opportunity is to first of all consider the break-even point of the business, and we'll show you why. So the break-even point for any business is that point where revenues minus expenses equals $0 in net income. And it turns out that we can calculate the break-even sales point for a business by dividing the overhead expenses of the business by the gross margin of the business. And so referring to the profit and loss statement for family medical practice, we can determine that the gross margin for this business is the gross profit divided by sales, which in this case is $11,500 for the gross profit, divided by the revenues of $15,000, which gives us a 77% gross margin for the business. And so we can calculate, using overhead expenses, the break-even sales dollars point of the business as the overhead divided by the gross margin gives a break-even sales point of $13,831. And what that means is, in a given month, the family medical practice has to generate revenues of $13,831 in order to break even. Now, after they reach that break-even point in any given month, any revenues beyond that point start to generate positive net income. We can also look at this in a different way by calculating how many patients does the practice need to see in a month to break even. And that's just simply taking the break-even sales dollars point and dividing that by how much we charge each patient tells us that we need to see 92 patients in a month in order to break even. And so any patients that we see beyond 92 starts to generate positive net income for the business. So given this, there's a couple of questions we could think about. First of all, if it takes 92 patients per month for the medical practice to break even, what is the value of patient number 93? Well, that's pretty easy to work out. We know that patient number 93 will generate revenues of $150 for the practice. We know that we will consume some supplies to see the patient. And if you refer back to the profit and loss statement, you'll see that we consume $15 on average of supplies for every patient that we see. And then, of course, there's the physician's assistant salary. But for patient 93, we're already past break even. So that person's salary has been paid for this month. And so there's $0 contribution from the physician's assistant. And so that means the gross profit we generate for seeing patient number 93 is $135. Now from that, we have to subtract overhead. But again, since patient number 93 is beyond our break-even point, all that overhead's been paid for. And so overhead contribution to patient number 93 is $0. And so the net income we generate from patient number 93 is $135. Now, let's think about a new pricing example that this family practice might encounter. Let's pretend it's the last day of a month, and there is 1 hour left before the office closes. And in that last hour of the last day of the month, the doctor doesn't have any patients scheduled for that last hour. Okay, this is the scenario. Now, a homeless looking man walks into the practice. He tells the receptionist that he's hurting very badly and that he needs to see a doctor. And the receptionist says, no problem. The doctor is available. That will be $150. Well, the homeless man tells the receptionist, all I have is $40 in cash. Will you let me see the doctor? And so what's going to be our answer? Will we let him see the doctor? Will we not let him see the doctor? And why? And so the receptionist goes to the business manager for the family practice and says, what should we do with this guy? Well, the financial or the business manager says, if we see him, we'll generate a revenue of $40. We'll consume about $15 in supplies to see him. The physician's assistant won't cost us anything more because we're past a break even for the month. It's the last day of the month. It's the last hour. We're past a break even. And so we'll generate a gross profit of $25 to see this guy. And since we're past break even in the practice, the overhead contribution will also be $0. And so the net income from seeing this homeless guy will be $25. Now, $25 is not a lot of money, but currently we have no patients for the doctor to see in the last hour before we close the practice for the month and we close the books for the practice for the month. So yeah, let's see the homeless man and let's generate that extra $25. So this is an example of a special situation where a business can take on an increment of additional business at a far lower price than they would ordinarily charge and still have that generate a positive net income. Let's look at this in a little bit different way, considering a competitive bidding example. Let's say there's a company in our town that has 100 employees, and this company wants to offer free annual medical exams to each employee in order to emphasize the importance of employee health. And so they go out and they talk to medical practice number 1 in town, which has a very good reputation. They've been in practice for a long time, and they ask them to submit a bid to provide 100 medical examinations to these employees. Likewise, they go out to a second medical practice in town, which has also been around for a long time, has a very good reputation, and they ask them to submit a bid to provide 100 medical exams for their employees. Now, it turns out that medical practice number 1 is very profitable. They have a little bit of excess capacity available in their business. They're well beyond break even. And so they consider that, hey, we can submit a very competitive bid and still make some money off of that very competitive bid. And so they submit a bid of $40 for an exam. Now, medical practice 2, which has a great reputation, is in a different situation. They've just gone through a major expansion. They've spent a lot of money on the expansion, and now they have a lot of excess capacity. And in fact, they're losing money every month because they're not using very much of that capacity. So they look at this opportunity to provide 100 medical exams as a great opportunity to help fill out their capacity. But since they're losing money, they're hesitant to offer much of a discount off of their normal price. But to try to make an effort here, they submit a bid of $140 per exam instead of their list price of $150. Well, given this situation, which medical practice do you think the company is going to choose? Well, certainly they're going to choose this medical practice. And these folks will win the bid because they've been able to submit a variable cost-based price that the other medical practice can't compete with. So before we end, here's some thoughts on using variable cost-based pricing. First of all, it's a very powerful tool for getting more business when fixed costs are covered by your existing portfolio of business. However, we need to be cautious when offering a variable cost-based price for extended contracts if there are times during the year when our seasonal volume could dip below our break-even point. An example of this would be restaurants or other food service businesses in northern latitudes that often don't break even during the very dark and cold winter months. Variable cost-based prices during those periods of time might be a real challenge for those businesses because they're not at break even. In any case, you always want to know what your cost position is. Are you running routinely past break even? Because if you are, then you might be in a position to offer a variable cost-based price to take on an increment of business.
Now here's something you may not know. Variable cost-based pricing shows up a lot in competitive bidding. You know, there's that one guy who submits the low bid and everyone else is trying to figure out how he makes a profit with that bid. You think that guy must be crazy, but in reality he might be as smart as a fox because he knows his costs and he knows how to perform the work on an incremental basis with no increase in his overhead expenses, so he can go with that variable cost-based price. Now remember, this is our last video for the year, so don't forget to hit that subscribe button so you don't miss a single video next year. And as always, I look forward to seeing you again.